As well as your common or garden stocks and bonds, a balanced investment portfolio may well include alternative investments. These often higher risk, but potentially higher reward, investments include hedge funds, crowdfunding, art, cryptocurrencies, private equity, and venture capital. But one group of alternative investments, that has both a real-world utility, and compared to others, comparatively low risk, is real estate, or property. Property investments tend to be considered more slow and stable, because apartments and office blocks aren't directly traded on an exchange, even if big property-owning companies can be. This helps insulate real estate from daily swings in value. UK commercial real estate saw total returns of 6% in 2018, and UK residential real estate, houses and apartments, returned around 3%, although there were regional variations, naturally. If you are a beginner of invest in property in UK, you have chosen the best video to know about invest in property in UK. This is a guidance for startup investing property in UK. Let's go to the video and dig deeper. Why invest in property? As the owner of a property, you stand to benefit from any rise in its value, when it comes to selling, from the income it can generate, if you rent to tenants, and, of course, from the utility you get from living in, or using it yourself. Interestingly, the attractiveness of property ownership is partly dependent on culture. In the UK, for example, individual ownership is fetishized, an Englishman's home is his castle. But in countries like France and Germany, the idea of someone not owning any real estate isn't unusual at all. What about real estate stocks? Easy their partner. Yup, some investors may prefer to invest in real estate via the stock market, buying shares in companies, which own properties and act as landlords, generating income in the form of rent. Because they're listed companies, of course, the values of their stocks are subject to daily swing. But these companies are also asset-backed, they own real estate which investors can see and touch, which has a relatively stable value, and which the company can sell, if it needs additional cash. That means their investors should be less likely to take flight in times of market turbulence, than if they were backing, say, some tech companies whose assets aren't as tangible. In an economic downturn, however, it's worth remembering that property prices may fall as well as stocks, potentially hitting you with a double whammy. Traditional buying. Buying a property that you live in is an investment, since you benefit from any increase in the property's value over time. But you can't live in more than one place at once. Let's turn our attention for a moment to buying a domestic property that you intend to rent out. With such an investment, you aim to make money in two different ways. Through growth in the property's value, and through rental income that exceeds any mortgage payments. A mortgage is a long-term loan secured against the real estate you want to buy. Benefits. One of the key benefits of investing in property via buy-to-let is control. As the owner, you decide the fate of your investment. If and when to sell, how much rent to charge, and what shade to paint the front door. You're also generating rental income over time, and if you have long-term tenants, it's a relatively stable source of income. One of the reasons buy-to-let is very popular among retirees. And, of course, if your property increases in value, you stand to make substantial gains if you choose to sell. Drawbacks. The large deposit often needed to buy a house or apartment can, of course, be off-putting. With buy-to-let purchases, the typical deposit required in the UK is 25% of the property's price. An average property in London, for example, would require a £118,000 deposit, too pricey for the average Brit, especially if you're paying a mortgage to keep a roof over your own head. And then there's stamp duty to consider. Buying via the stock market. One popular way to invest in property is through real estate investment trusts, or REITs. These were introduced in the UK in 2007, to provide an easier way for people to invest in property, and many are listed on the stock market. At least 75% of a REIT's profits must come from property rental, as opposed to building, and they're required to distribute 90% of their property rental income to investors as dividends. This reliable form of income, since tenants' leases are often agreed for years ahead, can make REITs an attractive investment. REITs typically own large portfolios of commercial property, providing investors with some diversification. But ultimately, the types of properties they own are key to their performance as an investment. For example, real estate investment trust SEGRO focuses on properties like warehouses, vital infrastructure for booming e-commerce operations, which have led to it growing earnings in recent years. On the other hand, over 50% of British Land's income comes from retail tenants, and many of those in its monster malls are being frequented less and less by shoppers. There are two types of REITs to be aware of, each with different features. Open-ended REITs don't have a set number of shares. New shares are created for buyers, whose money is added to the trust. When they sell, those shares disappear. One key risk is that several large sellers at once could force the REIT to sell off properties, in order to free up cash to return to investors. Closed-end REITs, by contrast, have a fixed number of shares, like most public companies which get onto the stock market through an initial public offering. Buying via private funds. Investors who prefer to avoid the stock market might look to get involved in a private property fund. These pool together individual investors' money to buy real estate, managed by a team which charges investors a fee, and often a portion of any profit, for the privilege. Such funds aren't very accessible to the average investor, with large minimum amounts required precluding all but the wealthiest of individuals from participating. Investors in property funds typically agree to having their money tied up for a set amount of time, so this option offers less liquidity than if they'd invested in a publicly traded REIT, in which investors can buy and sell shares at will. Capital. How much cash do you have to invest in property? Historically, you needed enough money for a deposit to begin your journey up the property ladder, by purchasing a property directly. But today, there are platforms which enable you to become a property investor with much smaller sums, in some cases as little as £100. Time. As with investing in general, you can choose to be very hands-on, hands-off, or a mix of the two. Active property investment involves buying a property yourself, maintaining its upkeep, and managing tenants, as well as their often numerous demands. Passive property investors pay professionals to acquire and manage properties for them. And if you're upstairs, downstairs you might buy a property yourself, but pay someone to deal with your tenants when the plumbing packs up. Risk. How can you best fit property into a balanced investment portfolio? In practice, the vast expense involved in traditional ownership of bricks and mortar means it can easily end up accounting for the lion's share of your investments. Even the uber-rich have a chunky 21% of their money tied up in physical property, excluding main and second homes, according to estate agent Knight Frank's 2019 Wealth Report. In this video we brought you through the basics, which you should look at before investing properties in UK. This is a beginner-friendly guidance for you to follow. If you got this video helpful, please give a thumbs up to the video. Don't forget to share this with your friends. Subscribe the channel for more important videos like this. Thanks for watching.